Okay, let's get right into this. On the surface, this is a story about banking reform. But if you look just a little bit closer, it starts to feel more like a detective story. We're talking missing data, lowered standards, and a potential deficit that could be hitting the people who can least afford it. This is the case of the hidden deficit. And this one question, this is really the key that unlocks the whole mystery. It points to a huge contradiction right at the heart of a brand new policy. Think about it. If you suddenly relax the rules, it's usually because someone's having a hard time following them. But to figure out who and just how bad it is, you need the data. So the question is, where is it? So to really get what's going on, we have to start with the official story. Back in 2025, the government and the RBI rolled out what at first looked like really great news for cooperative societies. These were changes that were supposed to get more money flowing into rural communities. But was it really all good news? Let's, unpack what these new rules actually were. Okay, so at first glance, these changes look pretty simple and pretty positive. The lending limit for dairy cooperatives literally doubled, which should mean more cash for farmers. And at the same time, the acceptable rate for bad loans, what they call NPAs, was bumped up from 5% to 7%. So that gives banks a wider safety net for defaults. So on paper, this sounds amazing, right? More credit, a bigger safety net. So what's the catch? Well, as we're about to find out, the problem isn't the safety net itself, it's why you'd need that bigger safety net in the first place. And that right there, that leads us to our first major clue. And the thing is, it's been hiding in plain sight this whole time, right in the definition of what's now considered an acceptable level of failure. Before we go any further, let's just make sure we're all on the same page with this term, NPA, or non-performing asset. It's just a bit of banking jargon for a loan that's gone bad. The borrower isn't paying it back like they were supposed to, and it's at risk of becoming a total loss. Simple as that. And this chart just shows it perfectly. The government didn't actually fix the problem that was causing bad loans. They just moved the goalposts. The bar for what's considered acceptable performance was just lowered from 5% to 7%. I mean, imagine getting a pass grade for a score that used to be a fail. That's pretty much what happened here. And this quote just nails it. This wasn't a reform to make the system better. It was an adjustment to make a failing system look like it was passing. It's a signal that maybe, just maybe, the government has given up on fixing the real root causes of why these loans are defaulting. Okay, so with that national picture in mind, let's zoom in on the real heart of our investigation, the state of Meghalaya, and a complete and total black hole where some really crucial financial data should be. This is the million-dollar question, isn't it? Or I guess the multi-crore rupee question. If the national standard for bad loans had to be raised, it strongly implies that states like Meghalaya are struggling. The question is, by how much? And here's the answer. It's kind of stunning. The truth is, we just don't know. The information isn't public. For a sector that handles public money and is supposed to be the backbone of the rural economy, this is a massive, massive red flag. And listen, we're not talking about some minor, trivial details here. We're missing the entire big picture. How much money has been loaned out in total? What percentage of that has gone bad? How many agricultural societies are in default? And are the banks getting any of that defaulted money back? Without these basic facts, there is zero public accountability. None. So you gotta ask, why the secrecy? Hiding data on this scale, it usually serves a purpose. It lets a problem get bigger and bigger in the dark, where no one can see it. So let's try to uncover the likely motive here. See, rising defaults are rarely an accident. They're a symptom of a much deeper failure in governance. It could be political pressure to hand out loans to friends and family, not to the farmers who actually deserve them. It might be weak bank staff who don't properly check if a borrower can even repay. And, crucially, it's often a system where there are no real consequences for people who just decide not to pay their loans back. Hiding the data hides all of this. And at the end of the day, let's not forget who really pays the price for all of this. A cooperative credit system that's just bogged down by bad loans and secrecy isn't doing its job. The money that should be going to real, genuine small farmers and entrepreneurs gets stuck, and the whole system becomes incredibly fragile. But here's the thing. The story doesn't have to end here, because secrecy can't survive the spotlight. This isn't just a problem for regulators to solve, it's a challenge for every single one of us. It's your turn to become the investigator.
And you can start with 3 simple but incredibly powerful steps. First, ask. Go to your local cooperative society and ask about its loan status. That gets the conversation started right at the grassroots level. Second, verify. Go to your district bank and check its official NPA rate. That holds them directly accountable. And finally, challenge. Challenge the authorities, the Department of Cooperation, to publish all of this credit data. This is how systemic change actually begins.
Because in the end, sunlight really is the best disinfectant. The data is there, it's just not being shared. The case of the hidden deficit can be solved, but it requires us, the public, to start asking the right questions. So the final question really is for you. Will you demand transparency?